Hello and welcome to Double Entry Bookkeeping, Advanced Bookkeeping AAT Level 3. And today what we're going to do is non-current assets, so fixed assets and depreciation. So that's what they're called by AAT, non-current assets. Really, actually, they are tangible fixed assets. So they're things that I can touch. That's what tangible means, as opposed to intangible, which would be things like goodwill and brands, things that you couldn't touch. But things that I can touch, like cars and vans and land and buildings and computers and office furniture, things that I can physically touch, and they're fixed. They go from year to year. We're not really sort of using it up in the year, like some, let's say some tin foil or something that we're or sheet metal that we're creating cans out of, that we're putting things in and selling. No, these are things that we're going to use like a van, and we're going to use it year to year. So what we're going to do today, well, we're going to evaluate the impact of invoice accounting, remember cash accounting, when we have fixed assets. And we're going to see how that's not going to work. And then we're going to determine what the elements of a cost should be for a particular asset. You're going to receive a sort of question and you actually have to work out what the cost of this asset is that we're going to capitalize. And then we're going to create the adjustments in the accounts for the reduction in the value of this asset each year. And we're also as well going to show how we're going to dispose of an item. So this is going to cover all the questions that we're going to receive in the AAT exam. So tips up front. What we're going to have then is you're going to read the fixed asset note. It's going to show you what method of depreciation we're going to use. We have two: straight line method or reducing balance, or diminishing balance as ones call it. We're going to show you the rates that are going to be used for those ones. It's also going to show you when a fixed asset is included and when it is not. So when it's capitalized and included within the what's known as the fixed asset register, or it's not. So things less than a particular value is probably not going to be capitalized, but there's going to be a trick in there which we'll show you in a minute. What you must do in this is you must use T accounts. So if you're not using T accounts, then you're going to make a horrible mistakes. You just lay out the whole of the T accounts, and that's the big trick actually, to see whether you'll try and avoid doing T accounts for all of the transactions, and so you just try and shortcut and do a few. So we've got our thing. Then we buy this van for £10,000 in year one, in our unusual timeline that we have in here, and we're going to sell this van for £2,000 in year 4. And over that period of time, each of these years, we've been using this van and driving it around and making all of our sales and what have you in there though. And what happens in invoice accounting? Well, invoice accounting, we've bought the van in year 1, so we've gone debit van £10,000, van at cost, and we've gone credit this bank £10,000. We've had this van, we keep going around, we keep driving it around, whatever. It's really reducing in value, but we don't do anything to that because we're in invoice accounting or cash accounting land. And in the year 4, we sell this van for £2,000 because it's now started to fall apart a bit. And what we do is we go credit the van, £10,000 at cost in there. We've gone debit bank £2,000 for the money that we've got in, what's known as the residual value of the van here. And then we've got this loss. And this loss is the disposal of the asset, and that's an £8,000 loss. So we've gone debit, loss, and disposal. Did that really happen? Well, that wasn't really what happened. Each year, we've been using this van, and each year then we've had a cost of using it. So that's not really, invoice accounting is not really showing us what should be happening compared to accruals accounting. So let's do accruals accounting then, see what would happen here. We bought this van for £10,000, we sell it for £2,000 in year 4, and each year we got this expense. Now I've set up what's known as straight line method here, so an equal expense each year. So this van cost here, our opening cost, minus the residual value, divided by the 4 years that we have it, what's known as the useful economic life in there, gives us £2,000 expense in each year. Our carrying value in the accounts has dropped down. So at the end of the year 1 it was 8,000, then it's 6,000 at the end of year 2, 4,000 at the end of year 3, and then in year 4 then it's worth £2,000, then we sell it. Notice, however, that the van actual market value might be different to this. It might be sort of 6,000 here, 5,000 here, 4,000 here, let's say, and 2,000 here, whatever. But that's not what we're trying to show in the accounts. We don't show market values in the accounts. We just show the carrying value based on historical cost here. So that's that one method of doing it. And what we see then here is we've got to try and work out a method of how we're going to show this carrying value and this expense in each year. And the way that we're going to do that is we're going to apply a charge in each year for depreciation. That's what we're going to call it. Something called depreciation in there, and we're going to have this accumulated depreciation that's going to add up, and then we're going to take it off this van, which we're going to hold at cost, but we'll have this liability, this credit in our trial balance, accumulated depreciation. We'll have our van at cost in there, and so our net is going to be the carrying value within the accounts. At the end of it then, we'll have an asset worth £2,000, we sell it for £2,000, and then there's no loss at the end of the year. We've had those depreciations. Now there might actually be a difference in there. We might get this wrong. We might have a slightly different disposal value to the carrying value, in which case we'd have a profit or loss on disposal, and that'll be one of the questions in there. But that's pretty much what we're trying to do, is trying to get to a position whereby we don't really have profits and loss on disposals. We've recognised our depreciation in each year as we're going along. So we've got our historical cost accounting. And what we're going to do here is, what are we going to value this thing in? So previously we're sort of saying, actually, this might not bear any relationship to market value. So provided we are going to continue trading and we're a going concern for another 12 months, we're going to value this using historical cost less the accumulated depreciation. We're not going to be looking at market value and making an adjustment. Then we're going to apportion that reduction in the carrying value and apportion the reduction of value over the economic life to the profit and loss account each year based on that historical cost and not on current value. So we've got two costs in here. We've got a depreciation charge for the year, and then in the final year, when we're going to get rid of the thing, that we've got a profit or loss and disposal of the asset. So we're going to have two calculations. One, you're going to be asked, what is the depreciation charge? And eventually you're probably going to get some kind of disposal of the asset, profit and loss and disposal. Okay, so let's do the depreciation charge first. We've got two methods that a company might use. So we've got to read the notes in here. So we have two methods. One's going to be the straight line method. So the reason why it's a straight line is because it's an equal amount of cost in each year. And so the other one is a reducing balance. So that's a different one. It's it has a high level of depreciation at the start, and that reduces as we're going through, and reduces over time. So the amount of depreciation gets less each year. So we're going to have two methods in there to what we're going to use, and also as well we've got two methods of how we can calculate the depreciation. We might have, let's say, something which your note will say depreciation is full in the year of acquisition and none in the year of disposal. So regardless of when you bought it, if you bought it in the year, you get a full year's worth of depreciation charge in the first year. They keep going depreciating it, but when you dispose it, you get none of it. Alternatively, you might have, well, it's by each full month of purchase, in which case you can have a timeline out and you're going to work out how many months are in each year, and you're going to be going along and working that position out. Even with the other method, where it's a full year in the first year and none in the last year, I'd still line out a timeline and put when I bought it and when I sold it, and that makes it a lot easier. So you may or may not have in the year of disposal. You might do, you might not. So you use timelines quite heavily within this one. Definitely lay it out in there. You will reduce your error rate quite significantly and make life a lot easier. So what do we do then? Step one, we're going to create our opening T accounts in our questions. We're going to put all of our assets in. We're going to put our fixed assets at cost. I'm going to show you an example of this at the end. And we're going to have fixed assets at cost, and they're going to be separate for a reason. We have this depreciation figures as well, separate. Then what we're going to do is we're going to enter our transaction into our T accounts. So what's the purchase of the asset? So this is the first question you're going to get. What is the cost of this asset? Now, cost of the asset is going to be everything required to put the asset into place. So it's everything required to put it into place. So it will include any additional items attached to the asset, like a bracket or something to put the floor right or something like that to get it stuck together. It's also going to include delivery charges and installation. Okay, but it will not include any consumables that come along with the items, such as printer charges, paper, tanks of fuel, etc. So what we're going to see, and we're going to have some kind of thing. We're going to look at it as well. The next point we're going to look at is we're going to sort of say, well, should this asset be capitalized or not? You'll see in the note, you'll say that items up to a particular, less than a particular amount are not capitalized. So I say items less than £500 are not capitalized. And you'll have an item within some kind of invoice that you'll see, and it will have a figure in there like a lamp or something else like that. And anything less than that note value will not be capitalized. And that was because of something called materiality. Theoretically, it should be capitalized, but to capitalize all little lamps and plugs and plug sockets and things like extension leads, all that kind of thing, all these small little items would just be a bit of a pain really, and all get a little bit silly. We'd have a fixed asset register that went on forever and a day. So we don't bother with that on the basis of materiality. But we're going to have to watch for the trick here. There's going to be an item that's going to be part of a larger item that's under the note limit, but because it's part of this larger item, it's above it and gets added to it. So we'll see some examples here like that. So let's see what we've got here. So we've got an example here. We bought this QX printer, this laser printer in here, and we've got this amount. That's above our note value. Let's say this note value is £500. That's above it. That's great. Okay. We've got this next day delivery charge. Anything that puts it into situ would be added on. So that would, in this instance, then we're up to £780. But look, see, here's the trick. Here's the printer cartridges, and they're a consumable, so they shouldn't be in the price. There. It'll tell you whether or not VAT is recoverable. If VAT was recoverable, it wouldn't be in the historical cost. If VAT is not recoverable, then it would be. Let's say we also had in here some kind of floor leveling thing for this printer to go onto, and that was an extra cost in there. That would be added into the price. So anything that's required to get it into place, but not these things here. This is an expense in the year. That's a profit and loss account charged out for printer cartridges. So your first thing you're going to get is some form of invoice like this, with little things in there, with brackets probably attached to the serial number over here, or some delivery charges that are going to add on. That's going to be what is the cost. Now there'll be some silly little consumable thing or there that actually shouldn't be included in there, and then you have to make your decisions up, make your mind up over VAT whether it's recoverable or not. And then what we're going to do is we're going to work out the depreciation charge. So straight line method. Then let's do that first of all. We got the start cost and we got the end residual value and we got the years of use. That's what we're looking for. Either the years of use or the rates. So depreciation would be in straight line start cost minus the residual value, the end value. So start cost minus residual value divided by what's known as the useful economic life, the years of use, or alternatively it's going to be start cost minus end value times by the rate, the percentage. So that's going to be the method for straight line. Reducing balance is going to be the carrying value brought forward. So the cost minus any depreciation to date times by whatever rate it is. So let's say I had an asset of £10,000 and it was 30% reducing balance or diminishing value. And then in the first year I've gone and it's £10,000 purchase and 30% diminishing value. In the first year I've gone down. I've added £3,000, so that will be £10,000 minus the £3,000. So my carrying cost is £7,000. And in the second year, I have £7,000 times by 30%. That's 2,100. So then my carrying value is going to be 4,900. And in the third year, I times that 4,900 by 30%, and that the depreciation charge will be 1,470 for that year. And we just keep going on like that further a day until we then sell it. So straight line is so because it's a straight line. It's equal amount. Reducing balance reduces, so starts high and then keeps reducing as we're going through, or diminishing value starts high and keeps reducing as we're going through. Now, what you're probably thinking is, well, we're putting in our T accounts and we've got the asset at cost, and we've also got this separate depreciation. So you've got a debit for the asset, and you've also got a credit for the cumulative depreciation that are going along. Why not just have a net figure? Why not put them in together? Because we could just deduct one from the other and just carry in the balance sheet one account which has the cost and the depreciation in all in one. Why have two accounts? Fixed asset cost and depreciation to date. And the reason why is because it gives an indication of the quality of the assets, which could go in two directions really. On the one hand, it could be that, let's say I've got a lot of very heavily depreciated assets, means I might need to replace a load of them, so I might have some cash requirement going up front. Or alternatively, I've got a lot of very heavily depreciated assets, I've got a lot of cost and a lot of depreciation. Actually, they might be worth more than really I'm sort of saying. So that's the reason why we showed two things, because you can look at it from a point of view of a set of accounts. Now, so we've got our cost and we've done our first part of our question. What we're going to get second? Well, we're going to have to put it into something called the non-current asset register. So the non-current asset register in real life actually called the fixed asset register. It's a list of all the assets. It's got the cost in there. It's also got the cumulative depreciation to date, and it'll have some kind of purchase method like a hire purchase or finance lease or from cash from the bank. In real life, it will also as well have the location. AAT doesn't seem to like to put the location in the fixed asset register, even though that is actually the most useful thing in the fixed asset register most often. However, there we go. Now all this is, so you also are going to have your ledger accounts, your normal general ledger with your T accounts. So all of your T accounting, your assets at cost, your depreciation calculations, whatever, are going to go into this general ledger accounts. It's also going to be listed out in the non-current asset or the fixed asset register. And all this fixed asset register is simply another control a bit like your purchase ledger, a bit like your sales ledger, a comparison against your general ledger. Is this general ledger accurate? Later on, you can have a look at your assets. You can go and find them, go and see where they are there. Do they all exist? Are they all still got that value? Whatever. Compare the total in here to the figures in your general ledger account. Just another control account. That's all it is. But first part of the question is typically going to be creating a fixed asset register with an invoice. What should we capitalize in there, and how should we calculate depreciation? So now what we're going to do is we're going to have a disposal. So we've had these assets. We've gone away, we've used our van all the way through, and we're now going to have profit and loss on disposal. And so that's what we're going to be looking at now. And what we're going to do is we're going to create T accounts. Now what I would say here is I'm going to show you in a minute a worked example. And what we're going to do is we're going to have our T accounts, and we're going to then transfer the cost of our accumulated depreciation to something called a disposals account. And this really is a workings account where we're going to put all these items. We're going to work out what the profit and loss on disposal is, and we're going to transfer that to the profit and loss account. So it's like a workings account for the profit and loss account, a bit like an income or expenditure, but it could be either way. You could make a profit or you could make a loss on disposal. You're then going to put. So what we're going to do is I'll show you how it's going to work. So here we've got a question in here. We bought this vehicle here for £10,000. Right. Now the question is going to give you some workings here and there, and then it's going to give you one or two T accounts to create. I've made this T account a bit thicker, but this is the trick. What you should actually do is you should put all of your T accounts down here. So have a load of the T accounts and work through it in detail. If you just go straight away and try and produce this, you'll make a mistake. Whereas if you produce all your T accounts straight away, so I've got here. So we bought this van. This van here, let's go back. This van here we bought at £10,000. So we've gone debit van, and we've gone credit cash in some kind. But this was in the previous year, so I've not put it in. We've got the reclaimed the VAT, so it's got plus VAT. So you got to work out with that. And I tend to put in my notes VAT at the top there if I'm reclaiming it or not. We then got depreciation of 30% per year on diminishing balance basis here. So I've gone depreciation in year 1, 3,000. I think in this one we sell the asset in after the second year. So I've gone year 1 and year 2 of my accumulated depreciation. Then I have this thing called the disposals account, and you'll see here. Oh, there we go. There's vehicles at cost here. There's also later on a few other accounts. So I've got my vehicles at cost in here, and I've got this disposals account. They'll usually call it disposals, and that'll be it. I put little profit and loss and disposal in my workings just to remind myself that this isn't a profit and loss account. So I've gone credit my van at cost, debit my profit and loss disposal. I go debit my accumulated depreciation, and I go credit my profit and loss and disposal. And what this does is it gets out of the way, gets this van that I bought off the cost, and also gets the accumulated depreciation associated with this van out as well. So these now have gone down to 0. So when I dispose this asset, I take out the costs, and I take out the depreciation, and I put them into this disposal, profit and loss and disposal. And then, in this instance, in this question in here, I sold the van for £5,200. I had VAT that apparently was reclaimable on the sale of this van. It's actually not technically correct in terms of HM Revenue Customs VAT registration, but never mind. So I've got this disposal 5,200 that I went debit bank, credit disposal account, and together with the accumulated depreciation, we then work out really, and we balance down our account, and this is the transfer down to profit and loss account. So in this instance, we had a van that was worth 4,900. We sold it for 5,200, so we made a profit of £300. So that is all that we have on these disposal accounts. There's some work examples later on this playlist, but really all we're doing here is do T accounts. In this question, what we were asked for was the vehicles at cost account. I think we were asked for the bank account and the profit and loss disposal one. They left these two out deliberately, and the reason why they leave them out deliberately is to try and see whether you will try and immediately try and answer these things, do it in your head and whatever, rather than doing it easily, which is just do the full set of T accounts. So at the end of this playlist, you've got a whole series of worked examples now. So this is worked examples of 4 assessments. Within it, the first 2 questions are fixed asset, non-current asset questions in terms of the creation of a register, fixed asset register, and the calculations of disposals. So the easiest way to do this is really to sort of, we've had a bit of a skim through, but now to actually get out the questions or the assessments that I've got, go and have a look at the videos for these particular ones and just work through alongside with myself. And good luck. Thanks for listening.